All right, so this is going to be kind of like a replacement video for the class that we missed. This is going to be not even a full class that we had to cover Module 10, so I'm just going to go through it. It'll probably be pretty quick. Um, so we had talked up to this point, and we'll kind of go through it the next couple of days, fiscal policy, so things the government can do in terms of spending to close inflationary, deflationary gaps, some of the impacts of that. Um, Now, what we also can see is the government doesn't change spending, but the Fed, which is you know, a body of the government, can use what we call monetary policy. So before we kind of dive too deep into it, we're going to think about kind of what is money, right? So money is really any medium that's accepted for the exchange of goods and services. So if you go back in time enough, this was like shells and gold and silver, which we still use, right? Some of those precious metals, but primarily today we're thinking about. Let's see, I don't think I have on here, but primarily it's like people think of it as cash, and we'll kind of talk about other forms of money here in a second. But if you want to, for now, think about it as cash. So it's a medium of exchange. Everybody agrees that this $10 bill is worth $10, right? And however things are priced, we're willing to accept it as a payment, and we're willing to kind of give it up. So it's also going to be a unit of accounting, a store of value, and a way in which we can defer payments for the future. So we'll kind of talk through through these a little more in depth here. But these are our characteristics of money. So as a medium of exchange, it's really going to be any asset that a seller would accept. So they might accept cash, they'll accept payment from your bank account, they'll accept a credit card payment, they'll accept, you could even offer to give them stocks and bonds, right? As long as they're willing to accept that asset, it's a medium of exchange. Now, some of these are more, but there's very small transaction costs to when we buy and sell, we agree upon this amount of money that we're exchanging or this asset that we're exchanging. And there's very little loss of value with that asset. And so the most liquid you can think about is cash. When I hand over a $10 bill, there's no transaction cost. If we didn't have taxes, which we don't have to, there's literally no transaction cost, right? It takes a split second for us to exchange this $10 bill. And then also, it doesn't, even though currency increases or decreases in value over time, in the short term, it's not like inflation happens within the next day, right? So it's going to be kind of our most liquid asset. Now, if I had something like, let's say I agree to take a certificate of deposit from you, well, if it doesn't mature for another year, that's not very liquid. I can't use that money for another year. I don't have it available to me. It's also going to be unit of accounting. So this is just going to be, we have this medium of exchange and we agree that this good is worth, five of these units of whatever currency we're looking at, right? Currencies vary across countries. So it's going to be a way in which we assign value in terms of prices to different goods and services. So it's this common denominator within an economy that everyone kind of agrees um, on its value. Right? So it's a standard value of all kind of accept, 10 US dollars is 10 US dollars. Okay. So a store of value, right? Hopefully, if we have a stable currency, this is going to be something that when I receive money from you, I don't think that it's going to lose its value very quickly, right? And so you, more volatile currency, it's going to be less likely that someone's willing to accept it because it may be worth quite a bit less in the next month if that's not a stable currency, right? So the store of value of money is its ability to hold that value over time, and that's going to vary across different types of currency and different types of assets. Stocks are a little bit more, right? There's more variation in what their prices are that could plummet, and so it doesn't hold its value as much as the US dollar. Okay? Um, so because it keeps its value, it allows us to take money today and, excuse me, ensure that we're going to increase our wealth in the future. This is the idea, even if it's not cash, if it's a stock, I think that holding that stock is going to likely produce higher payoffs or be of higher value in the future. And so it's a way to kind of transfer money, value today to kind of value in the future. So I already kind of mentioned this. What compromises this idea of money or this store of value? An unstable currency. If I think that this economy, all of a sudden this country could go to war in the next weak, and that's going to, really devolve economic conditions and make their currency worth, decrease in value significantly, it's not going to have very good store value. Now, if this has been a country that, the currency has been remained pretty stable over the last 100 years, that's going to have a lot more store, a much more respected kind of store value there. And then we can kind of, defer payment. This is the idea that I can give up whatever this asset is today and then have more value in the future to kind of settle debts or to pay for goods and services down the road. So once again, when would this not be a good asset to defer payment? If there's a risk that this currency is going to be devalued, or the risk that that asset, think about it, like a stock, is going to go to zero, right? A price of zero. So these are kind of four characteristics. And then we'll talk about more of like what money supply looks like. So there's some definition stuff. We're going to go through this pretty quick because we're not going to hone in this too much. But M1 is what we call, so we're going to think of the money supply overall, which is how much currency and checkable deposits, right? How many of these assets exist. It would be kind of our current currency that's in circulation. Also, kind of our checkable deposits. These are things like bank accounts, promises to pay, even the use of credit cards. And so anything that's in these financial institutions, checkable deposits, would also be kind of counted as M1. So it's not physical currency, but it's a store of value in someone's bank account. Okay. So if you look at the US right now, I think the amount of cash that's in circulation is what, 5.6 trillion. Whoops. And then we've got another almost 4 trillion checkable deposits. So it's not quite a 50-50 breakdown, but pretty close, right? So I think here, might have updated these numbers a little bit because this doesn't quite match up. Oh, sorry. This isn't cash. There is $5.6 trillion of M1. Of that, about 4 trillion of it is checkable deposits. So we have like a 30-70% kind of breakdown there. So a lot more checkable deposits than currency. If you go back 50 years, probably looked a little bit more higher percentage on currency, right? I don't carry much cash on me at all these days, right? Most of my money is in a checkable deposit. Now, M2 is going to be another definition of the money supply, which includes M1. All right, so all this cash, all these checkable deposits, but it also includes things like savings accounts. Right? So not checking account, but savings accounts where people have money in different assets, like even if this is like a certificate of deposit. And it may not be things that are quite as liquid as M1, right? It takes time for a certificate of deposit to mature, but it's fairly liquid, right? You could also think about if we have funds for businesses that are, somewhat tied up, but they can't be necessarily used today, but they're pretty accessible over the next month or two. This would be kind of included in M2 as well. So in 2020, this is more of an accounting thing, but they switched over savings accounts into M1. Typically, it had been only included in M2. And so because savings accounts are so liquid now, they basically kind of switched that category over to be included in M1 as well. So things have changed over time because of technology, but overall, we're looking at this, you can kind of see M1 versus M2. I mean, it used to be that cash and checkable deposits, there's a significant amount of money that were in these savings accounts that wasn't being counted as M1. The government said these are basically just as liquid as cash. Once we started including these in M1, you'll notice the difference is very small. So they're pretty much the same thing, and they kind of move in the same direction. You kind of notice these trend lines almost identical. So setting us up for who's going to be doing this monetary policy, it's going to be the Federal Reserve. Right? So they started over 100 years ago. It's the central bank of the United States. I probably will reference them as the Fed, not the Federal Reserve System. That's usually how we kind of you'll hear about them in the news. So they're not politicians. They're not elected, but they're appointed by politicians in Congress. So there's 12 different banks throughout the US, right? They're all part of the Fed, but they all kind of have their own region that they are responsible for. So I think I have a map here. Yeah. So there's 12 different banks. You can kind of see, the East Coast has a few more. This is kind of when they first originated, right? There's a lot more of the population of the US in this area, not as much here. And so we don't need as many banks in these lower populated areas, but we do have 12 of them. Okay. So what is the Federal Reserve? What's their role? Right? So they're going to supply the economy with currency or this medium of exchange. Right? They're also going to provide a mechanism for which people can clear these different checkable deposits. Right? And this isn't necessarily people, but more often banks can kind of clear these. So we'll talk more about that in depth. And then they also kind of hold cash or currency or M1 that they can loan out to different institutions. We call these reserves. And then, like I said before, so it's not government spending, but it is a way in which it is the body in which the government that is responsible for the government's use of increase or decrease in the money supply, not government spending, in order to influence spending, savings, and we'll ultimately see interest rates and even um, as a byproduct of that, the price level in the economy. Okay. They also supervise kind of banks. So even though they're the largest bank, and they are the government's bank, they supervise kind of these other private banks as well. Okay. It's also the government, if they wanted to lend out money to someone, it's kind of their last resort. Right? If they don't have the funds, the Fed can kind of do this. Right? And then they regulate the money supply. And I don't think we'll dive too much in this, but they can intervene in the foreign currency markets to make sure our currency is kind of stable across the world landscape. So these are all kind of the functions. We won't dive too deep into them, but just kind of setting up this body exists, and this is kind of their role. Okay. So what the Fed will do is kind of through what we call these open market um, uh, I'm blanking on the word. So it's an open market. They can buy and sell bonds in the open market, or I think here I call the Federal Open Market Committee. They have some decisions to make, which is basically we want to change interest rates because what do interest rates do? They increase or decrease the cost of borrowing. Well, if we increase or decrease the cost of borrowing, we can change consumers' behaviors, but we can also change companies' investment decisions. Right? So we don't have any direct control over the overall interest rate in the economy, but they can influence the money supply, which will then have a subsequent impact on these interest rates. So you might hear in the news, oh, the Fed is setting the interest rate at this. They're not technically setting the interest rate. They're manipulating, I shouldn't say manipulating. They're adjusting the money supply so that they can achieve goal interest rates. Right? So, who's on this open market committee? It's a board of governors, and they're going to be making these decisions. Right? So there's 7 members on this committee. They're appointed by the president. Once again, they're not elected, but they are appointed by people who were elected. Okay? Of those 12 banks, there's these 7 who are appointed, but 5 of them, right, are going to come from the Federal Reserve banks. Well, 5 of those 12. So a total of 12 members, 7 are appointed, 5 of them come from 12 of these banks. And then by rule, the New York Fed is always going to be one of those 5. This probably comes from more like a historical thing, right? That's where the bulk of the economy has primarily kind of been the highest populated areas kind of in that region. So they always kind of get that bank president on the board. All right. So what the Fed is going to do is hold something called reserves. All right. So they've got this money set aside, these assets set aside, and we're going to call these their reserves. So this is always going to be an amount that is less than the total deposits that the federal banking system has. So if they have, I don't know, $1 million, the reserves might only be 100,000. Right? I'm just choosing numbers here. So there's going to be these legal total reserves, right? Which is what they allow other banks to kind of claim, right? So this is going to be money that the bank has to have set aside, but it's not loaning out, it's not lending, because if they loan everything out and then all of a sudden everybody wants to collect on those loans, they might not have enough liquid assets to kind of meet all of those promises to pay. Okay? So we're going to have the total reserves, but then there's also going to be the amount that they have to set aside. Okay? So these required reserves are going to have to be things that are set aside that can be very liquid, right? Cash and deposits that if somebody wants to kind of collect on this loan or they've lent this money out, excuse me, they could kind of buy those back like instantly. Right? So there's going to be a ratio that's set of these reserves, how much of them have to be held as cash or deposits. We're going to call that the required reserve ratio of your total reserves that you have set aside. How much of it has to be held in cash or deposits? So all of it is going to be, amount that you can't lend, but a certain amount of it has to be something that is liquid. Okay? And then whatever we have left, this is our excess reserves, right? This is going to be the amount that's kind of set aside that could be not have to be held as cash. Right? So required plus excess reserves equal our total reserves. That's pretty easy, I think, equation there. So I'm going to try not to get or ask for questions since there's no one to ask question or answer or ask questions here. But we'll keep kind of moving on. Oh, there we go. So this open market operations that the committee kind of takes on is they are going to purchase or sell U.S. government securities. So these are government-backed securities or assets, and the Fed will kind of sell them or buy them back. Right? So they're not just giving money away, right? They're buying or selling this physical, I shouldn't say physical asset, but this financial asset or security. Okay? So this could be loans, different financial products, right? Oops. So if we kind of think about like what I shouldn't say a balance sheet, if you have accounting, this isn't really a complete balance sheet, but it's a kind of simplified version of it. So if we think about the Federal Reserve, they have all these checkable deposits, right? So this is how much money they might owe, right, to other people in terms of the loans they've taken out. Well, they're going to have a certain amount of total reserves. So they've given out $800,000 in loans. Their checkable deposits is the value that they have total, right? So of that $1 million, they're giving $800,000 out in loans, but they have to have a certain amount of assets set aside, right? This is what we're going to call the total reserves. So they've got $200,000 set aside. Now, we said some of that's going to have to be held in these excess reserves, which is cash or very liquid. Okay? Right now, I just kind of got it set up. They don't have any of those in sorry, they've got all of it in the required reserves. None of it's in these excess reserves. So everything's in cash or these sorry, go back to kind of lines up. All of it's kind of in cash or these deposits that are very liquid. Okay? So that's kind of the scenario that we start out in. So here we'd have a required reserve ratio of what? Well, if I've got $1 million total in my assets, I'm holding aside 200,000, my required reserve ratio would be 20%, right? Just that ratio of my total reserves to the amount of total assets that I have. Okay? So that's my required reserve ratio. Now, what happens if the bank accepts $100,000 in new deposits? Right? So, people are wanting to purchase these bonds. They give the Fed $100,000 to purchase them. These are new deposits into their bank. Well, of that $100,000, if we had that required reserve ratio of 20%, they're going to have to take what? $200 and put it into these required reserves. Okay? So, as I say 200, sorry, we're dealing in millions. So this would be 200 million. Or not 200 million, sorry. We had $1 million, so it's going to be 200,000, right, if we take 20% of that. Okay? So anytime there's new deposits into this bank, some of it's going to have to be set aside. $100,000, we have to kind of set aside $20,000 as this bank. So our excess reserves are going to be our total reserves minus the required amount. So we've seen the amount of checkable deposits go up by 100,000. So before it was 200,000, now it's 300. We were previously holding 200,000 in those required reserves. We're now going to have to hold an additional 20,000. So what's the difference now? Well, before all of our total reserves were required, so we had no excess reserves. Now we have a total reserves of 300,000, but we only had to put 20,000 of that into our required reserves. The excess that we have is the difference between those. Okay, so what is this going to look like? Well, our total reserves went up by 100,000. Right, that was that kind of new deposit. Now we have this new deposit, right? That also increases our liabilities. So that increases the total liabilities and the total assets to 1,100,000. But of that additional 100,000 in reserves, only 20% of it had to be set aside into required reserves, which means we have $80,000 left over. Now, these required reserves, which is the idea of cash or checkable deposits that were held set aside, that if we had to have access to that, we would have readily available access. Excess reserves, we can take that money and put it into other financial products, or we could loan it out. Okay? So anytime we have a new deposit, right, notice the amount of loans we have didn't change. Still 800,000. You just have this additional $100,000 in assets in our reserves. So M1 hasn't changed at all, right? So the total amount of assets are the same, right? That weren't included in reserves, everything's going to remain the same. That same $800,000 in loans. So what should we do with these excess reserves? Well, if they just sit there, they're not earning the bank anything. So what are they going to do? They're going to loan them out. All right. There's going to be an interest rate on that. And whoever they give it to is going to promise to pay back even more than the amount of money the bank is loaning out. And so they can essentially make money by loaning out these excess reserves. So when I say loaning them out, this could be that they're investing them, right? Putting money into the stock of a company, right? Essentially, what they're doing, they're purchasing a stock, is they're giving out money, right? They're investing into these different projects, or they're issuing new loans where someone's promising to pay them back more in the future. So if we had that same value, right, of the excess reserve, so 80,000, that was our kind of value that we were working with in our earlier example. We're going to take that and loan it out, right? So our new liabilities, right, we're loaning these out or have to be matched with our deposits. So both of them are going to increase by 80,000. So the amount of loans, once I take these excess reserves and I give them, and I start to loan them out, that's also going to increase the amount of loans that the bank has. So before, even though the number or the amount of loans we had was 800,000, as I start to loan out these excess reserves, those are going to be kind of captured in this loan category. But I'm really just moving this money, right? That kind of asset liability looks like it stays the same. But as I loan out that money, I'm going to have an increased liability. So what's going to happen? Stick down here. There we go. Is once I loan that money out, right? Well, that's still part of my reserves. I'm just using it now to give, I'm using that amount of money I'm giving out that loans because I have that to cover those loans. When I give out those new loans, I now kind of have this liability of I'd have to be able to pay back that 80,000. So once we loan out those excess reserves, we influence both the assets and liabilities column, or essentially we've increased the money supply, right? There's more money now out in circulation. So as we see these new deposits made into the Federal Reserve Bank, that increases their total reserves. Some of it has to be set aside, dictated what percent, whatever that required reserve ratio is, of the leftover funds, right? These excess reserves, they will start to loan those out. That essentially increases the money supply. Okay. So if we had a required reserves ratio of 100%, nothing can change, right? We had no money to loan out, the money supply would stay the same. So we don't want that required reserve ratio to be 100%, right? Otherwise, we can't create new money, or we can't, I shouldn't say create new money. We can't increase the money supply. So we'll just work through some kind of numerical examples here. But let's say we had these checkable deposits, or these deposits into the Fed, increase by 80,000. So if it's 80,000, right, and we have a required reserve ratio of 20%, how much of that has to be set aside? So we give out these loans of $80,000, right? People take those, they then kind of make new deposits of 80,000 to the Federal Reserve's assets that they have to set aside 20% of that, or 16,000. Well, of the remaining, 64,000, right? They don't have to set that aside. That's not part of their required reserves. That becomes excess reserves. They can then loan out that additional money, right? So even though the required reserves goes up, I now have another 64,000 in excess reserves. I can then loan that out. And then once that's loaned out, the deposits that come back in, these new checkable deposits, would be 64,000. I have to set 20% of that aside, et cetera, et cetera, et cetera. So the initial amount of the loan was increasing the money supply by, we said, 80,000. However, once that money's out there, it then becomes, money that can be invested back into the banks, or increase these assets, increase our total reserves, which then creates more excess reserves that we can loan out. And essentially, this process continues. And then what is the total effect of that initial 100,000? Well, it wasn't that just 80,000, because that process continues. Essentially, that first check, that first deposit ends up increasing money supply by not just that amount times the required, or times one minus the required reserve ratio. That money keeps on getting invested. We said that process occurs over and over and over. the actual effect of that $100,000 deposit is going to be multiplied by 1 over whatever that required reserve ratio is. Okay? You could do the math. I think there's an example in Top Hat that kind of goes through like 10 periods or 10 like cycles of this, setting aside some of the money, loaning out the excess reserves, et cetera, et cetera. And what we see is that there's a money multiplier, kind of similar to multiplier effects that we had before, which you can kind of think about this as we talked about money multipliers before. It was like 1 over the um, essentially marginal propensity to save. Well, here, how much money are we saving, or do we have to set aside whatever that required reserve ratio is? So this money multiplier is essentially the same thing that we had when we were looking at consumers. It's just that instead of the marginal propensity to save by consumers, it's the marginal propensity to save essentially by these banks, which is set. Like it's not that they're choosing it; it's set to be this required reserve ratio. But in terms of calculating that money multiplier, we're really doing the same thing. Okay? So just to kind of line up, instead of just me verbally saying this, right? We said what was the kind of multiplier effect we were talking about before with consumers? It was 1 over 1 minus the marginal propensity to consume. However, this is the marginal propensity to save. So this is 1 over the marginal propensity to save. For the banks, right, this money multiplier is going to be 1 over, well, kind of similar, what's the bank's marginal propensity to save? It's whatever that required reserve ratio is set. Okay. Or set at, I should say. Now, similar to that marginal propensity to save, even though we typically talk about that required reserve ratio as a percent, here we're always going to be using whatever that decimal form is. Right? That's what kind of tells us this, how we would calculate this multiplier. Okay. All right. There we go. So the total change in our money supply will be kind of whatever that initial change is in our excess reserves times that money multiplier. Okay. Now, notice this is the change in our excess reserves. It's not the initial deposit. So this is, you almost think about this as like, what's the initial excess reserves created by this deposit? The impact would be whatever that change in excess reserves is times this multiplier. So it's almost like that first period, right? We're not really receiving $100,000, right? We're not saving all that. We only have the remaining 80,000 to then loan out. So what is the effect of that remaining 80,000? 80,000 times whatever the money multiplier is. Okay. So this would be kind of the equation that we would have for that. Okay. So nothing too crazy here. Now at this point, I want to make a distinction between if there's a new deposit, this is how we calculate the change in the money supply. What if instead the bank isn't receiving this deposit and then having to set some of it aside, but they're buying an asset? Well, this isn't part of our total reserves. So whatever that loan amount is, they don't have to set any of it aside. So there is no, it's not impacted by the required reserve ratio. So instead of having this new deposit of 100,000, but only being able to loan out 80,000 of it, if they buy this bond or this asset, they essentially can loan out all of that, right? So compared to that previous example, we don't have $80,000 to be loaned out. We now have that full 100,000. So I'm just assuming here that that deposit is the exact same value as the bond or the asset that the Fed was buying. And so now they don't just have 80,000, they have $100,000 to kind of take and loan out. So after that first loan, we don't see a change in that required reserve ratio. We would still find the money multiplier the same way, because even though they don't have to set aside any of this $100,000, as soon as they loan it out, the money that then comes back in as a checkable or as a deposit, they then have to set aside 20% of that. So the only real difference is the initial starting amount is not 80,000, it is 100,000. So that change in assets is now the asset that they purchased, this bond, it's $100,000. So that same $100,000 coming in as a bond as opposed to like a new deposit into the bank, the impact it has in the money supply is 500,000 compared to 400,000. So these initial deposits will have a smaller impact on the money supply than if it was that same dollar or same value, and the Fed instead was purchasing a bond. So the purchasing of these bonds, we call that kind of the open market operations of the Fed. They're buying or selling a bond as opposed to kind of receiving a new deposit. Okay, so I just spliced these videos together. We'll kind of pick up where we left off, or where I left off. Just working through some examples, things you could kind of expect to see on the daily quiz that's going to be associated with this video. So here we'll kind of the end of the slides. We have, if the Fed loans out all of its excess reserves, what would the effect on the money supply be from a $200,000 increase in checkable deposits if the required reserve ratio is 15%? Okay. So if we think about that required reserve ratio is 15%, the kind of new deposit that we see is 200,000. All right. So if that's the case, what's the total effect on our money supply of this? Okay. Well, we said you would think of initially the kind of that change in money supply is the change in, right? Now here we can kind of think about this as like the change in the deposit times that multiplier effect. Okay. So if we were to calculate it this way, right? I've kind of made an error, right? Because if I kind of just plug in that $200,000, I then figure out that that multiplier is equal to 1 over, not 15, but 0.15. Okay. So that would give me approximately a multiplier of what, 6.66 repeated. If I then multiply that by 200,000, get what? This is my calculator here, so I get 100 and so 6.66 repeated. I would have the total change in the money supply is 1,333,333.33 repeated. Now, that doesn't look, it looks really large, right? But that's because of that multiplier effect. However, I made an error here because this would be the effect on the money supply if that came from open market operations, from the buying of bonds. Because this wasn't from the buying of bonds, it was a new deposit that was made. What's that initial kind of change? It's not the deposit amount. Remember, we said kind of that change in the money supply is the initial change in our excess reserves times that multiplier. So what would our excess reserves be? Or what would that change be if we had that $200,000 deposit? So you can kind of think about it's whatever my deposit is, but the amount that I have is only going to be 1 minus, right? However much I have to kind of however much I have to set aside, right? Or that required reserve ratio. Now this is going to be in terms of a decimal, right? So this would be the idea if my required reserve ratio is 15%, well, I have to set aside 15% of that, which means I'm not setting aside 85%, right? So that initial $200,000 deposit, right? The amount that I'm going to have left over to actually loan out would be what? So 0.85 times 200,000, I'd have only $170,000. Okay. So instead of that whole amount, right, the actual change in my money supply from a new deposit is whatever change in the excess reserves that new deposit caused. Now, if it wasn't a new deposit and it was the open market operations of the Fed, they were buying this bond, we would use the 200,000. But because it was a new deposit, the amount of excess reserves that we actually have is whatever the initial deposit was times 1 minus that required reserve ratio. So if we're then making this calculation, we've got the same multiplier effect, but now that change in the money supply is going to be that change in my excess reserves times that multiplier effect. So now this is going to be what? 170,000 times that 6.66 repeated. So now if we do this calculation, sorry, we would have what? 170, 1, 2, 3 times 6.66 repeated. We would get approximately 1,132,000. So a little bit less, right, than if this was done through open market operations. Open market operations will always cause a change in the money supply that's greater than the change in the money supply caused from a new deposit to the bank. And that's because that new deposit into the bank, a certain percent of it has to be held kind of aside. So our excess reserves are always going to be a little bit lower than whatever that initial deposit was. Okay. So here the actual answer would be this right here. And I'm doing some rounding here, but this would be approximately what it is. On the daily quiz, I'll kind of have this set to be a margin of error just in case you round a little bit differently. But as long as you get it to kind of that 1,132,000, we should be okay there. Okay. All right. And I'll make a point here in a second as well. So let's say instead, we did see that the Fed decreases their total reserves by $100,000 through open market operations. We have the required reserve ratio of 8%. What would the total change in the money supply be? Well, here, if I have a decrease, right, in my total reserves, and it's done through open market operations, so it's a decrease of 100,000. The change in that money supply is the change in my excess reserves. But if this comes from the buying and the selling of an asset, it doesn't get impacted. I don't have to set any of it additional amount of it aside. So this is essentially going to be whatever the value of that asset was times the multiplier. So this is what? Negative 100,000. Here, I think I did a required reserve ratio of 8%. So this is going to get multiplied by, well, what's my multiplier? It's 1 over that required reserve ratio, but as a decimal. Right? So I can kind of get this into my calculator. I can kind of break this down step by step. So we got 1 divided by 0.08. That's going to give us a multiplier of 12.5. So now if I take that, multiply it by that initial change in my total reserves of 100,000, I get that change would be what? Yeah, 1,250,000. Okay. Now, if this same thing was done, but it's not through a kind of a new deposit, right? It's not done through open market operations, what would we have, right? Well, that change in the money supply, that initial kind of sale, it would have to be that it's not all that same $100,000. If the reserve ratio was 8%, then we're going to see what? 92,000, which if you then multiply that by 12.5, what's that going to be there? We would have what? 12.5 times 92,000. We get what? 150. Okay. So notice kind of in our similar scenario, and this is all decreases, right? Because we're kind of decreasing the total amount of reserves we have here. So you'll notice the effect of open market operations is always going to be larger than the effect of new deposits or kind of people taking money out of those reserves, right? So if we want to kind of summarize this, the change in the money supply from open market operations is always going to be greater than the change in the money supply from like new deposits or withdrawals. I'll move my hand here in a second. Okay. All right. Another thing that I just want to point out here, and maybe this will be kind of the second question I have in the quiz, is what's going to happen to that change in the money supply from the same, and here it doesn't matter if we do open market operations or new deposit. So let's just say we have kind of this new deposit, which we've already kind of taken out. We said it's not the full amount of the deposit, it's whatever that new deposit is times 1 minus, whoops, that required reserve ratio. So one thing that we can kind of see, so how is this, it's going to actually have a twofold effect because we're multiplying this by the multiplier, which is here, right? So if that required reserve ratio goes up, what's going to happen to that change in the money supply? Well, initially, if this goes up, this fraction goes down, that's going to decrease our money supply. If this goes up, we're subtracting a larger value. This would also go down. So both of those things would be driving down the effect of that initial deposit. As we increase that required reserve ratio, it's going to lessen the effect on the money supply of that same initial new deposit. And that would apply to either if we have kind of this new deposit or if we have open market operations. The open market operations is a little bit easier, but because we said there, it's going to be like the change in the asset, right? The buying or selling of that asset. And then none of that has to be held aside. So it's just times 1 over the required reserve ratio or the multiplier effect. Well, there it's a little bit easier to see. That decreases kind of the change in the money supply as well. So increases in that required reserve ratio, regardless of it's done through open market operations or if it's done through kind of new deposits or withdrawals, that change in the money supply will always be smaller if that required reserve ratio goes up. And that kind of makes sense because if we have to set more money aside and we can't loan it back out, right? That's what the required reserve ratio is telling us, that we have to set more of this money aside. We don't have as much to loan out. We're not going to be able to influence that money supply as much. So that really, in a nutshell, is Module 10. I'll kind of get this video posted and we will jump into Module 11 then on Thursday. So I'm expecting you kind of have watched this before then. And we'll kind of dive deeper into monetary policy by the Fed.